Happy Monday and welcome to our next webinar series at AIM Summit webinars focused on real estate investment in the post-COVID world. We have with us today two experts in real estate investment and we'll be hosting a 1-hour webinar for all of you. Please feel free to utilize the Q&A. There will be a Q&A session at the end. Please submit questions throughout the process of the webinar, and we will address as many of the questions as we can. I have with me today Ian Russ and Jay Hwang. Ian Russ manages the investment activities at Delta Rhino Capital's funds and direct investments. Prior to DRC, Ian was the Chief Investment Officer of PCFC Investments and was responsible for the firm's real estate and VC strategy. Earlier, as Director and Asset Manager of one of Dubai's sovereign wealth funds, he oversaw a global multi-billion-dollar investment portfolio. Previously, as Assistant VP at Northmark Capital, Ian structured over $4 billion of project-based debt and equity investments through a network of institutional capital sources and government agencies. He graduated magna cum laude from Loyola University Chicago with a BA in economics and international business. Jay Hwang, who's going to be starting the presentation today, Jay develops the investment thesis for Delta Rhino Capital's funds and leads the firm's venture activities. Prior to DRC, Jay was the Chief Strategy Officer of PCFC Investments, where he accelerated the launch, stabilization, and market positioning of the QE2 hotel. Earlier, he co-founded MBLM Dubai and spearheaded the strategy and senior executive advisory services for clients across real estate, tourism, B2B, energy, finance, and hospitality. Previously, Jay delivered the development, market positioning, and launch of over $1 billion of real estate projects in the GCC as executive director of Future Brand. He has a BA in political science from Columbia University. Jay, it's such a pleasure to have you discussing this with us today. Please tell us what is happening in the real estate market in the post-COVID world and what can we expect?
Thank you, Zachary, for the introduction. And thank you to Raha and to the AIM Summit for putting this together. Over the next 25 minutes or so, we'll be sharing our perspective on US commercial real estate, specifically in the context of the pandemic. The current pandemic is unprecedented on several fronts. We have not experienced a singular event that is truly global in scale, cuts across all economic sectors, and changes the way we live, the way we work, the way we play, and if you happen to have school-age children, even in the way we learn. And because real estate is inherently tied to the live, work, play dynamics, it's not that surprising to see that the pandemic has had a profound impact across all property types. But the impact has not been uniform. To determine where the investment opportunities lie in the current climate, we need to take a more nuanced look. And as we go through each of the property types, our analysis is anchored in what we call an investor's first approach. We're looking through the available industry data, firsthand on the ground information to answer the question of where is the best opportunity to invest our own capital. Accordingly, we favor strategies that provide stable cash dividends, minimizes risk, and has the potential to produce long-term capital appreciation. So with that, let's take a look at the office. You're looking at US office leasing activity up to the first quarter of 2020. In the first quarter of this year, you saw a 34% decline in activity compared to the same period the previous year. Notice that the slowdown in activity was happening before the pandemic really came into full swing in the United States. That being so, we don't expect the numbers to be much better in the upcoming months. And when you add to that companies like Twitter and all of its 1.6 million square foot of office space announcing that it's going to make work from home a permanent option for all of its employees, It's almost fashionable to proclaim the death of the office. And while that view is certainly headline worthy, it's rather a blanket assessment. If companies implement best practices based on the current social distancing guidelines, otherwise a 6 feet of space in between people, companies can be in a situation where they don't have room to accommodate a third of their employees. And even if a company were to lay off a third of their workforce, they still end up requiring the same amount of square footage, at least for the foreseeable future. It's important to not confuse an evolution of office space with the elimination of the office space. Yes, the new normal or the new way we will work will probably include a mix of rotating shifts, adoption of remote working, and a repurposing of the office space as a place to get work done to a place to connect and interact. I recently spoke with the head of technology for an equity trading solutions company based in New York City. His point of view is interesting in that he and his company has been practicing remote working for the past 8 years. And one of his key takeaways for the overall productivity and success of this practice is he highlighted the importance of having a collective physical space where everyone can get together from time to time. So when you take all the factors into consideration, we actually see a continued opportunities in the office. In the current climate, we are looking and we're seeking out high quality core assets. Geographically, we like secondary cities. We see greater growth potential due to the lower cost of living for employees and real estate prices for companies in cities in Texas, Florida, and other Midwestern states. In terms of assets, we're also looking for properties that have a strong corporate tenancy base. We think that large corporations are more likely to evolve their offices rather than to eliminate them. You know, worth to note, although it didn't get as much coverage, Twitter did confirm that they intend to keep all of the US retail spaces. So let's move on to retail. Retail is in trouble. They were in trouble prior to the pandemic. It predates the predicament that is facing US retail. It really predates the pandemic. We are in the middle of a fundamental change to consumer behavior when it comes to shopping. The current situation has only cemented the Amazon effect on established brick and mortar retailers. And we can see the impact it's having by looking at the retail vacancy rates, both historically and the forecast for the upcoming months. And you go a little bit deeper and just look a segment at malls. Right? Malls were already experiencing historical highs in terms of vacancy rates before the pandemic. And when you have stalwart retail brands and previously reliable anchor tenants like JCPenney's, Neiman Marcus, J. Crew filing for bankruptcy and facing an uphill battle, it's difficult to see a straight path forward for recovery. The discovery of a vaccine will not make the difficulties faced by these retailers disappear either. Retail is fundamentally governed by footfall. Essential retail like pharmacies and groceries has always, and will continue to generate its own footfall. Non-essential retail depends on footfall generation. With capacity restrictions impacting traditional footfall generators, non-essential retail will continue to suffer. As far as pure retail properties are concerned, we're definitely on the sidelines. Retail properties anchored by essential services or businesses that are takeout or delivery centric will probably be safer bets. But it's too early to indicate opportunities that can produce consistent cash yields. Having covered the retail and office briefly, let me now turn it over to my colleague Ian, who will take us through the outlook for multifamily, industrial, and retail.
Thank you, Jay. Continuing on, let's take a look at the most robust property type, multifamily apartments. We like multifamily. It's at the foundation of everyone's hierarchy of needs. The first dollars out of your pocket every month go to pay for food and housing. And this means that multifamily is an inherently recession-resistant property type, but not necessarily recession-proof. So with multifamily, to determine where to direct investment dollars, we're focusing heavily on two key figures, as you might expect, unemployment statistics, but also rental collection rates. Quickly, let's just touch on the unemployment figures, which are shocking. In the US, we have a labor pool of roughly 165 million active participants. The latest figures show unemployment claims from approximately 33.3 million people, which equates to a real unemployment rate just over 20%. Now, looking forward, the best estimates are that that will peak, those unemployment claims will peak at around 41 million, which would equate to a real unemployment rate of roughly 25%, which is an unemployment rate equal to that of the Great Depression. With respect to rental collection rates, nationally, there has been some impact. But it's been smaller than was anticipated. Even by the most optimistic estimates, it's been smaller than anticipated, at no more than a 5 percentage point decline month over month, year over year. Some forecasters had envisioned up to a 30 percentage point decline or 30% decline in rental collection rates at the height of the fear and uncertainty regarding the impacts of coronavirus. But thankfully, those doomsday predictions have not borne out, as we wouldn't expect that they would. The other point to note here, as far as multifamily is concerned, is that the impacts are generally, the economic impacts of the pandemic are generally being felt at the extreme top end of the property types, luxury Class A properties, as well as the other end of the spectrum, the lower end properties, Class C and below properties. But we'll touch on that in a bit more detail momentarily. In our existing portfolios and with the assets that we're looking at acquiring, that we're analyzing actively at the moment, we are actually generally seeing an even rosier picture, where rental collection rates are dropping by no more than 1%. So, and as you can see in the statistics on screen, we're actually seeing general improvements, a positive trend in rental collection rates month to month, year over year, where by May we're seeing figures that are significantly closing the gap between year over year periods. It'll be interesting to see what the June figures show once they come out here shortly. But as we all know, unemployment is soaring. Rent collections have been impacted, at least to some extent. So what matters is focusing on multifamily assets that are most resistant to those forces. So as we dig down a little deeper and look at specific specific classes of multifamily properties, we begin to see significant differentiation. As I mentioned, with Class A luxury products, there is significant softness. This has been a generally overbuilt property type over the last 5 years. So even pre-pandemic, supply was outpacing demand. Now, interestingly, one of the new trends that we were just seeing pre-pandemic, but is now going to be cemented quite strongly, is competition from single-family rentals. And more specifically, single-family rentals built by large professional national developers specifically for rental purposes as opposed to for sale purposes. And again, this is a new trend, And, as the focus on outdoor living and other in-home amenities, home offices, begins to pick up steam, we're likely to see increased competition between single-family rentals and luxury products. At the far other end of the spectrum with Class C properties, these are the properties that are most likely to have high proportions of tenants that are impacted by the economic ramifications of coronavirus. We expect occupancies, rates, and collections to be most at risk with lower-end Class C properties. We're already seeing this with rising occupancies and those those lower levels of collection rates on Class C properties. While due to their price, these properties may pick up some new tenants, but they're not likely to be sticky. As the economy improves, any any occupancy backfill that happens at the Class C properties will be very much at risk. As the economy improves, those tenants will look to trade back up as quickly as possible. Sitting in kind of the Goldilocks zone are Class B assets. They have a higher proportion of tenants in a position to weather the downturn, and any occupancy weakness that is there, which is probably significantly lower because as tenants are required to economize from Class A properties, they'll drop down to those Class B assets. And anybody looking to get out of a Class C asset is going to trade up to a Class B property. They're going to be in a strong position provided they remain competitive on a quality and an amenity basis to maintain those strong occupancy levels. And that demand from an occupancy perspective will help to support rental rates. So from a long-term perspective, we're quite bullish on Class B multifamily assets. Generally speaking, we see ongoing opportunities to invest in the right multifamily assets now and for the foreseeable future. As Jay pointed out, as with office, we like multifamily assets that are in secondary cities due to those appealing population density, cost of living, and cost of doing business dynamics. We like Class B assets, as I just explained, for the various strengths that they have relative to Class A or Class C assets. And we really like those assets that present opportunities to be competitive on a community and an amenity basis. So any properties that have an ability to really present strong competition on the live, work, play elements, which are now so heavily concentrated in one place, are going to be those best positioned to do well over the next 2 to 3 years and coming out of the recession that we're now in. So with all of that taken into consideration, we are actively targeting select multifamily investments. Shifting the focus to industrial assets, the two main factors here that are significantly impacting this property type are changing supply chain and logistics demand. This is the logistics, the industrial side of the Amazon effect. So let's start with changes to global supply chains. The chart that you see on the screen now provides a trend line for the percentage of US manufacturing that is done abroad as opposed to that which is done domestically. As expected, what you see is a trend over the last decade or so of increased offshoring. Now, what's interesting is that in 2019, we already began to see that trend reverse marginally, but reverse. So this is an interesting data point, but we're not yet sure if that has long-term legs, if it's enough to constitute a trend that would impact demand for industrial properties in the US. manufacturing processes are inherently complex, and as we all know, they are global in nature today. And any major changes to that system that would constitute significant reshoring of US manufacturing production would require massive amounts of capital investment, major changes to systems and processes, and training of large pools of skilled labor. So while it's possible that this reshoring will continue to maintain momentum, as as there are a lot of politicians that are strongly supportive of that, we simply don't yet know if it will occur to a degree significant enough to constitute a trend that will cause changes in demand for industrial properties. So it's something that we will keep an eye on. It's something of which to remain aware and to be able to be in a position to act quickly on if it represents a trend that is driving demand. Now let's consider the other major factor in industrial assets, the increased logistics demand. I think it's commonly accepted that habits formed during this period are likely to stick with us for the long term. I think the common wisdom is it takes 30 days to form a new habit. And at this point, we have globally, and keep that in mind, globally been in this position of changing the fundamental way that we are living our daily lives for 90 days. So it's quite likely that the pandemic will be the proverbial grain of sand that tips the scales in the favor of all business being digital first and physical second, particularly retailers. That's obviously where we're seeing it as the leading indicator, if you will, here. The figure you see on the screen offers evidence of an undeniable conclusion to this trend, at least from a retail perspective, that has been building steam for years, and the pandemic simply cemented. It's kind of a nail in the coffin for physical retail properties. But it's obviously a bright spot for warehouse and distribution properties, as it means the strong and lasting growth in demand for those types of assets. So looking at industrial collectively, the underlying fundamentals for logistics are strong, but that does mean that well-priced assets are going to be harder to find. Not impossible, but certainly harder to find. And growth opportunities, industrial assets with growth opportunities, manufacturing-related properties, it's still a bit too early to tell whether there's going to be a positive trend there. So we're taking a little bit of a wait and see view on those types of assets. But as far as industrial is concerned as a whole, we're taking a selective opportunistic approach to them in order to capitalize on those long-term positive trends, just with a mindful eye of making sure that any acquisitions are done at an appropriate cost basis. You don't want to overpay just to follow the trend of money fleeing into perceived safe haven assets. Moving on to hotels, this is a pretty easy and quick conversation, unfortunately. There's not much to say that isn't obvious as far as hotels are concerned. Along with retail, but even more so, hotels have been incredibly hard hit. By any KPI, this property type is in a tough spot. There's almost, in some contexts and in some instances, this is an existential moment for certain assets within hospitality. Very simply, the outlook is uncertain. A lot of properties won't be able to withstand the multifaceted impacts of the virus. There's growing consensus that as much as a third, or as many as a third of all urban hotels in the US will not be able to reopen as hotels. They simply can't withstand 2-3 years of non-existent demand. So with that in mind, the growing discussion is around adaptive reuse of hospitality properties. I won't get into much detail on this because there's so many X factors that will impact it. It's really not at this point, the discussion's not at a point to really be able to get into in detail, because even from a long term, from a short to medium or long term perspective, any adaptive reuse of a hotel property relies on fundamental demand for the property type to which it would be renovated or adapted. Hospitals and residential properties are the most natural, but this is perhaps hospitals are in some cases perhaps undersupplied, but even that is not clear. And we certainly don't have a shortage of residential properties in urban areas in the US. So, the future for hospitality really is simply uncertain at the moment. For the sector generally, the recovery is likely to be a long one. It will demand significant changes to revenue models, and it's almost entirely dependent upon the recovery of global travel. So while we are well experienced in hospitality and very comfortable with it as an asset class, it's too early to tell where appropriate risk returns are. And so we're on the sidelines here at the moment. So to summarize our collective view from a property type perspective, we see selective opportunities in industrial, multifamily, and yes, office. We quite like office. So before I wrap up here and hand this over to Zachary for the Q&A, I just want to touch on geography for a moment. We've mentioned it here and there throughout the presentation, but I just want to touch on it in a little more detail. Our view is that the pandemic will add further appeal to secondary and tertiary cities, which is a trend that we've been following for a number of years. Many cities that are in the geographies listed on screen have this kind of three-part appeal in a post-pandemic world. Two of which were certainly there before, which were vital before the pandemic. One which has really been cemented post-pandemic. The post-pandemic element are the population density dynamics. These are cities that kind of have that Goldilocks density. Enough people to sustain diverse local economies, but not too many that in the post-pandemic world, folks are going to feel crowded. All of them have, as Jay mentioned earlier, lower costs of doing business. We've been having extensive conversations with national leasing brokers who work on behalf of national corporate tenants. And it's almost a universal discussion, the discussion around closing down offices in places like Manhattan, Boston, LA, San Francisco, and opening offices in Indianapolis or San Antonio, or one discussion was even in Akron, Ohio. It's a very strong trend. Now, what's most interesting, like with Twitter, the discussion is not around closing offices or reducing office footprint for these national tenants. It's around moving to geographies that have better costs of living and better costs of doing business. And so as far as cost of living is concerned, this is a trend we've been following for a number of years. But it's especially for millennials and Gen Zs, places that have employment but attractive costs of living that allow them to get off the ground are fundamental and have a great long-term future and have simply been cemented as strong places going forward as a result of the pandemic.
Thank you for the presentation. Again, I have a lot of questions, and I'll encourage everybody in the audience to send your questions through the Q&A on the Zoom system. Firstly, during this crisis, there has been a flight to liquid assets. There's been a flight to safety. And when you say that that secondary markets and secondary cities are more attractive, are these not less liquid? Have they not been hit by this kind of flight to liquidity? Wouldn't the primary markets be kind of the more liquid option? Or if you could expand further on the thesis towards secondary cities and how this kind of flight to liquidity and other aspects of the crisis have impacted them versus primary markets.
Sure, that's a fair question. I think what's important, I mean, very simply, no. The secondary and tertiary cities do not have do not have worse liquidity than a primary market. And there are two factors that really impact and drive that fact. First and foremost is it's more about how the liquidity is there as opposed to whether or not liquidity is there. So, the first and foremost is the fact that the secondary and tertiary cities offer quite a bit more yield than primary markets. So, your yield on a particular asset in New York would be 300, 400, 500 basis points lower than that in a comparable secondary city like Chicago or Indianapolis. And as a result, while you may be targeting, your liquidity may come from a buyer, a different type of buyer. It may not be from, a Blackstone who has to deploy $10 billion. It may be from a family office, a high net worth buyer, a smaller institution. There are certainly buyers out there from whom you could derive liquidity, no doubt about it. And I think the second element to that is really where we find ourselves at the moment in time. The liquidity is going to increase very simply as the impacts of this economic event become completely felt. Those cities that have that more attractive cost of doing business and cost of living are going to be those cities that will see increased liquidity. There will be increased demand. We're at a moment in time where we can capitalize on that before that rising demand drives yields down as a result of increasing liquidity, even more than it already is. But I think you will actually see decreasing liquidity in those primary markets as a result of perceived complications on the back of the pandemic.
I also want to add that, supporting this, and our favor and our preference towards secondary cities it was not started by the pandemic. So this is not, the pandemic happened. We think secondary cities are great places for your investment. Rather, we've been monitoring both demographic, population, and yield trends over a set period of time before the pandemic. And that's a trend that has only accelerated and grown even further during the pandemic. So, I think that's an important distinction to understand, that it's a sentiment that has been building up and accelerated rather than something that has happened solely because of the pandemic.
So how do demographic trends compare in secondary cities to primary?
Very much depends on which city we're talking about, but we can use, very much depends on which city you're talking about, and then even within that city, it depends on which portion of the city. I'll use Chicago as an example of that. It's a city we know very well. While you may see headlines about the south side of Chicago having population decline, what you don't see is that the north side of the city, it's very much two cities in one. The north side of the city is having double-digit population growth over the last few years, driven very much by the cost of living dynamics. By a lot of measures, the cost of living in Chicago can be 55% that of LA, San Francisco, or New York, while incomes are only 5 to 10% lower. So your net your net financial position as someone living in Chicago is significantly higher, significantly improved over that of some of those other major cities. So Indianapolis is another city that obviously we've mentioned it a few times. We like it quite a lot, but is seeing, you know, tremendously strong population growth. And also just strong underlying fundamentals. We own properties in, you know, we're invested in properties in 2 or 3 northern Indianapolis suburbs where the median income is twice the national average, and unemployment rates remain in the kind of 3 to 4% range, even at the moment. So, you know, there are very strong pockets in central U.S. secondary cities that are really appealing at the moment.
So we talked about office. We talked about you know, companies having people work from home. Again, I'm sitting in my office here in DIFC, and I'm mandated to only have 50% of my employees here at any given time. You know, but you highlighted the statistic that a 1/3 reduction in employee density requires the same square footage. That being said, what about, you know, even if companies are, you know, reducing density, letting people work from home and making the offices less densely populated, what about unemployment? What about companies that are going out of business? How can you, you know, feel so confident about office and commercial real estate if the economy is looking so uncertain?
I mean, that's obviously a fair question in the environment. You know, one of the elements that we didn't touch on when we discussed office is the flip side of the coin of the types of tenants. As Jay pointed out, we're focused on those assets that have large corporates. Just to give you an example, right now we're looking at an asset where it has 85% occupied by 2 primary tenants, Disney and Northrop Grumman, which is an interesting tenant mix in this environment. You know, Disney's obviously all over the headlines, and Northrop Grumman being an aerospace related company. But what they are strong corporate tenants where they're not going to be leaving that office space. Again, they will be reducing their population density by about 1/3, but they'll be increasing the amount of square footage each employee requires, but decreasing the number of employees. So their office requirements, their space requirements remain about the same. Now, a lot of those companies that you're concerned about that you mentioned that could go out of business are likely to be SMEs. And those are tenants in office buildings that we would expect will vacate their space, will stop paying rent, and will move on to a full work from home scenario. But large corporates are unlikely, as is the case with Twitter. And we already know in this particular asset, you know, Disney and Northrop Grumman have reconfirmed their commitments to their long-term leases, which are 10 to 15 years in length. We're not, all those large corporates have experienced the importance of having that place to which employees can go periodically as a business efficiency, an element to the business efficiency. You know, IBM, I forget how many years ago it was, but, you know, many years ago, IBM let all of their, you know, when telecommuting became a thing, they let all of their employees start working from home if they wanted to. And then it was maybe 5 to 7 years ago that they started saying, you know what, we're realizing this just isn't working. And so they started to bring all their employees back into the office. So there's going to be a shift in office usage. There's no doubt about it. But whether or not office will continue to be a property type that large corporates lease and which provides a return, we don't think is at question.
Also, I think in this light, we're looking at an added layer of due diligence. You know, it's not only about, you know, what company name gets up on the office space that makes it a good tenant or not, or even going a level deeper and saying, okay, which department, which facet of the business line is currently occupying this tenancy. And then with that, I think you can get greater insights about, likelihood of whether that division is going to grow or not. So yes, it certainly requires a little bit more nuanced look at it. But as Ian said, we think that, with a strong corporate base, we still see great opportunities in office.
Okay, so pre versus post-COVID, the importance of tenant due diligence and tilting towards large spaces servicing large corporates rather than smaller spaces servicing SMEs would be the kind of post-COVID commercial real estate investment thesis?
That's a fair summary.
Okay, and so we talked about reduced density. Now, and we talked about, offices likely to be less densely occupied and utilized in the post-COVID environment. But at the same time, and you'd highlighted the attractiveness that individuals and households may find in single-family residences. But you also highlighted the attractiveness of multifamily. Now, is this kind of preference for reduced density not going to impact multifamily? Could you elaborate on why you feel so optimistic about multifamily residences?
Yeah, that's the answer to that question is a deeper dive. It's more specific. We very much see single family rentals are going to impact a certain tier of the multifamily space. But right now that is likely to be the luxury tier, that class A property, where you're able to pay 50, 75, 100% more for your rental housing, but what you want is more space. If you are already leasing a 2,500 square foot 3-bedroom luxury apartment, you very well may consider paying that same rate, but leasing a single family home of similar size that has a backyard, a swimming pool, and space for a home gym and your home office. We are very specifically bullish on Class B multifamily workforce housing, properties that have rental rates that are, in the target geographies we're discussing, say $800 to $1,200 a month for a 1-bedroom apartment, and those are kind of perennially recession resistant assets. But for the moment, there happens to be a lot of opportunity to acquire those assets are already well leased, but with the potential with minimum capital investment to do some minor capital renovations and really kind of future-proof them for the next 5 to 10 years, so that on the backside of this economic downturn, we have properties well positioned to be sold at compressed cap rates and really drive yield.
So expanding on cap rate compression, have you seen any effect of the significant fall in interest rates in the United States yet on the real estate market?
No, not really, because while rates have fallen, spreads have widened. So your all-in rate as a borrower on commercial property has actually remained about flat, more or less flat. We've seen, as far as cap rate compression is concerned, it really depends on the property type that we're looking at. As I referenced earlier, logistics, industrial assets have seen massive cap rate compression. We are seeing some cap rate compression on certain multifamily assets, and that's something that you simply have to kind of work around. You've got to move fast. When you find a good asset, you have to move fast, and you've got to look for opportunities where, and this is particularly appealing in this environment, where when we look for opportunistic acquisitions, we don't look for opportunistic acquisitions where there's problems with the asset itself. We're looking for opportunistic acquisitions where the real estate is fundamentally strong. A distribution warehouse that is fundamentally strong, well leased, but perhaps the sponsor, the owner, has weakness or is struggling in some other capacity, and they need as a result of this environment, they need liquidity, and we can step in and be that liquidity for them.
And are you starting to see those deals in the market yet, these liquidity-driven deals, or are you expecting those to come later in the year?
We were having this conversation about 45 days ago, and at that point, my response to that question was, we've got to wait. We're not going to see them quite yet. People are still trying to figure out whether or not there's any recovery from this, if it's just going to quote unquote end and we're going to go back to normal. We are now beginning, I think we're now at the leading edge, as everybody acknowledges that there is no going back to normal. We're going into whatever the new normal is, and we're just beginning to see those opportunities filter through. And as expected, a lot of those initial opportunities are in the hospitality space. And again, for those, we're generally on the sideline. But we have one industrial asset in front of us, and an 850,000 square foot distribution facility that has an interesting opportunistic element to it. So we're just beginning to see those come through.
So I have an interesting question from Fahim Sond, who's asked a question on the Q&A. And again, encourage everybody to use the Q&A on the platform. So most of the states and regions outlined in your presentation are also prone to climate change risk. How are you stress testing your models when you consider this risk? And how do you also underwrite risk in general to size your transactions?
It's a great question. I mean, climate change is obviously a big factor that we take into consideration. I would actually if you look at the map that is included in that presentation, it's really, when you're looking at those that are most exposed to climate change, it's really Texas and then some of those southeast coastal states. Again, our first step is we most actively target central U.S. cities that do not have that exposure. But simply given the strength of the network that we have in those regions, we will certainly consider cities that do have some exposure to climate change. Florida happens to be a state that we know very well. The state as a whole is not necessarily exposed to major climate change risk. Miami is much more exposed than the Gulf Coast of Florida. Generally hurricanes, the Gulf Coast of Florida is generally shielded from hurricane impacts and rising severe storms. But we generally target those geographies that are not prone to impacts from severe climate change. How do we incorporate that into our models? I think the easiest, the most simplistic answer to that question is we're generally quite conservative investors. Again, what's important is we take this perspective of an investor's first approach, where we're thinking about where we are investing our money, in addition to the partners alongside us. So we focus so heavily on cash yields and de-risking our position in a given asset immediately post-closing, that is a major element to how we address risk. So we're de-risking our position on a quarterly basis, since we're targeting assets that have, gross cash yields of 8.5%, 9% plus. So that generally allows us to perhaps take a little bit more risk if we wanted to, but we tend to not do that. And again, because we're as private equity investors, we're looking at 5-year holds. Climate change, while it does impact on it will have an impact on that 5 to 10 year term. The city of Miami isn't going to be wiped out in the next 5 to 10 years. And we will certainly be in a position to have earned our return on whatever investment we would have made in a market like that prior to climate change really impacting us. Any severe weather impacts would be insured against, obviously. So, that's really the major risk we'd be most concerned about.
Talking about hospitality, how do you, well, the overall effect on hospitality is obvious. How does it affect different segments of hospitality? Where do you see this impacting luxury versus upper mid-scale budget economy? Who do you think is going to be the most hit? Who's going to be the hard hit? And is this likely to have a greater impact in tier 1 markets where supply or room saturation is 100% or greater? This is a question from Sandeep Patel.
I would love to be able to give a very specific answer to that question. Again, we have very deep experience in hospitality. I myself spent a lot of years managing hospitality assets for the Dubai government globally. We do know that industry well, and we think it's frankly, it is simply too early to tell where that will be, where the impact will be most felt. This will certainly, there's a potential X factor here, which is interesting. Airbnb hosts are going to be are already heavily impacted by this, and you can expect to see those properties go back into the residential pool more than continue to provide shadow competition for the hospitality space in a lot of locations. So, there's this one element where you may have some relief of competition, some relief of supply, even in an environment of decreasing demand. But, right now, global travel has caused the impact to be felt across the board. When you have, all of the major airlines in the US have capacity reduced by 90% or greater at the moment. And there's no clarity on when demand for travel will begin to come back in earnest. So, I know it's a bit of an unsatisfactory answer, but I think that anybody that provides clear insight on where hospitality is going to be impacted is making a guess at best. And at this point, time has to tell the tale of where that pain will be most felt. But for the moment, it is being felt everywhere.
The other thing that is interesting is that when you look at in both retail cases and in hospitality, a recovery in order to consider recovery, you're looking at fundamental changes to the operational and revenue models, right? Just to simplify the effect, we all understand how much F&B, the portion F&B places for hospitality. So if you take buffets out of the equation, out of many of these hotel types, that is a significant hit. How do you continue your business, when a primary revenue driver is maybe no longer accessible? When you look at in those kind of operational manners, select service hotels who to begin with had very little F&B offerings to start with, may be a safer bet. But, I agree with Ian, it really needs to, I think it's a little too early to determine which of the social distancings or, guidelines that are here to stay or are temporary in nature.
We only have 5 minutes left, and there are a bunch of interesting questions, including some from a few of my friends. So, if I'll ask if we can try to cover as many questions as we can and keep it a little bit more as concise.
I'll give shorter answers
after. So Jan Borgstedt has asked, "What's your take on co-working and co-living space in light of the WeWork debacle?"
Jay can add his view on this as well. We were never big fans of the idea of WeWork as a company, only because they are really a tenant improvement contractor. They were really just doing fit out. But the idea of co-working generally, we think will pick up some steam, although, even as I say that, I think that the ability to work from home will potentially provide more, people will probably fit out home offices as in equal numbers as taking a co-working membership. But I think co-working is probably here to stay, just not simply not at the scale as what you saw with WeWork.
My dear friend Haitham Alani from here in Dubai has asked whether it's a time to be holding on to residential units or getting out now, or potentially increasing exposure to residential. What would your general view on Resi be?
If the question that underlies that is, should I keep my residential apartments that I invested in here in Dubai? I'd probably look to liquidate and take what capital I can get and move that somewhere else. In the U.S., obviously we are bullish on residential. It very much depends on where you buy and what you buy. But we really like residential. We're long-term investors. We always look at, from our perspective, while we will model a 5 or a 10-year hold, we will always look at an analysis of making sure we're comfortable with an asset if we had to hold it in perpetuity. So we make sure we're comfortable comfortable with it from that perspective. But residential, generally, we are quite strong, quite bullish on, just because it sits at the bottom of your hierarchy of needs.
Another question from Sandeep Patel. Is your real estate, both direct and the fund, structured to address Sharia investors? And one of the challenges that a lot of foreign investors have in buying property in the United States are taxes. So how do you deal with tax efficiency? I know that's a much more complicated question than it is, but is there a tax efficient way to invest in U.S. real estate? Is there a Sharia compliant way to invest in real estate? Is that something that you offer?
Those are both very common questions, and they're very simple for us to give a soundbite answer on. And obviously, as you point out, Zach, there's a lot of detail around it, especially the tax element. As far as Sharia compliant is concerned, we have extensive experience structuring Sharia compliant U.S. real estate investments. We've been doing it for over 12 years, both while in the U.S. In a previous life and while here in Dubai as well. So we have extensive experience working with life insurance companies, bank lenders, Fannie Mae, Freddie Mac, and we've done over $1 billion of U.S. real estate investment. And it's while it is not common and widespread in the U.S., we have a large and diverse network that allows for that. And we can certainly, on any direct investment program, we do generally, at this point, we are doing one Sharia compliant multifamily offering at the moment. And on the fund side of it, we are having that conversation as well. So it's really quite simple and straightforward, just a matter of structuring. On the tax side of it, while not simple and straightforward, it is something that we have done and we know how to do quite well. Yes, you do have to get around FERPTA issues and withholding tax issues, but there are two structures that are available to allow that to happen. You will never pay zero tax in the U.S., and I can say this being a U.S. taxpayer who has lived abroad for many years. But there are real estate is a tax-advantaged investment in the U.S. anyway, so there are highly tax-efficient ways to do it. We know how to do that.
So I'm going to ask two more questions from the audience as a closing remark, but because we are now over time, we've covered so much. We covered investing in U.S. real estate, what segments to invest in. So what your views are on office. Your views on office are much more optimistic than what a lot of people are saying. We understand that based on density and based on increased importance of tenant due diligence, looking for the large companies that are going to be there to stay. We discussed in residential, there's a very good sweet spot, a Goldilocks section in residential in this Class B that is not going to be as negatively impacted as Class A and Class C. You mentioned that despite the fact that interest rates have fallen, that prices prices have not yet reacted as a result. So you're getting wider spreads, you're getting better cap rates. You've discussed the fact that secondary cities, tertiary cities are much more favorable in terms of cap rates, in terms of outlook, in terms of demographics, if you're selectively identifying those markets. You discussed hospitality, don't touch it, wait and see. There's a lot that's going to be changing. A lot of these hotels may not exist in the future and may never reopen again. We discussed industrial, logistics, and the upside that's happening there from the Amazon effect, but the fact that you are competing with the Blackstones of the world, and that there's been significant yield compression. I really appreciate everything that you've discussed today. There were the final two questions have come from that I'd like to ask you as a closing remark. And please, any other additional closing remarks you'd like to throw in there are from for each of you. Is Rakesh Shah. He's asked, upcoming U.S. elections, any potential real estate implications or regulatory changes that may be happening as a result of all these changes that are happening with Trump in the U.S. And also on the opening up of economies, what your take is on residential and commercial market demand.
Yeah, U.S. elections are obviously theater that we all very much enjoy watching, especially, as we get closer and closer, and in this atypical environment where campaigning has been impacted the way that it has. There is perhaps there are perhaps some impacts. I think the most direct impact that could be felt would be some erosion of the positive. If President Trump is not reelected, there could be some negative impacts as a result of a new president overturning some positive tax benefits that have been enacted. But those are not significant net impacts, either positive or negative. Generally, any change that could happen would potentially lead to some volatility, but generally speaking, we don't, the presidential elections don't really, the outcome of them, other than from a tax perspective and in the most macroeconomic way, don't necessarily lead through to direct impacts on most of our portfolios. And in this environment, the presidential election couldn't have a greater impact than what the pandemic has had. And I'm sorry, what was the second question then, Zach?
Second question, I guess let's ask this one for Jay so we can close out because we're a little bit over time. Opening of economies, where our economies are starting to reopen. Any short-term response that you're seeing in residential or commercial market?
I think both the questions that you asked are actually related to one another. Whether it's the election or the opening of the economy, one thing that we learned very quickly is that trying to forecast anything at this particular time is problematic or very difficult. But since that is the case, what we are looking for is identifying live-work dynamics that actually had some momentum, prior to it, that we think that has sustaining power, and then reflecting upon those in light of whatever unexpected or unprecedented situations may happen, and then seeing which one of those dynamics are positive and how that can translate into the right investment opportunities. So I think with that in mind, that's why we're coming up with the specific recommendations of targeted investments in both multifamily, office, and industrial.
Great. Well, thank you guys. I really appreciate this. It's been very eye-opening. Again, I'd love to look at what more opportunities there are. Certainly, the opportunities that you've been looking at and that you've shared with me are very interesting. I think this has been a very a very useful webinar in terms of understanding what we can still touch, what we can still invest in, that there are opportunities, but that you have to be increasingly selective to make sure you're in the right segment, the right market, the right city. Differentiating your real estate portfolio is more important than ever. And I think you've made a compelling argument as to what works and what doesn't work. So again, I'd like to thank you both so much for participating and for sharing. And thank you again for everyone who was able to join us. Again, this has been another great AIM Summit webinar. I'd like to remind everybody that we have an upcoming webinar taking place on Bitcoin. And is this the time for Bitcoin? This has again been another asset class that has been performing year to date. We're having that discussion led by two of the largest investors in Bitcoin, Mike Novogratz, the former president of Fortress Group and the founder of Galaxy Digital, as well as Dan Moorhead, the founder of Pantera, the world's largest cryptocurrency fund. So please join us on June 10th for that webinar. And again, thank you so much to Ian and Jay and to the AIM Summit team for putting this all together. Thank you so much.